Like the other papers, we're looking at just the state of play. How are retirees faring? How are those on the brink of retirement faring? What does retirement mean for people? And actually, it is changing. So the future retirees will experience something very different from what current retirees are experiencing in a number of ways. We are macroeconomists. We tend to focus on the aggregate data, what's true for in the aggregate economy rather than sort of the individual level data that was in some of the other papers. And just to preview the results, one of the things we look at are some of the conundrums that appear in the retirement survey. So for example, the EBRI Retirement Confidence Survey, there's a couple of conundrums. One of the conundrums being a far greater fraction of people report that they will work in retirement than are actually working in retirement. And second conundrum is the expected age of retirement is rising quite rapidly amongst workers, but the actual age of retirement in recent years has been quite a bit earlier than people reported, or than that pattern would suggest. So there's, just to preview the results, there's two possible, and we find significant resolutions to those conundrums. One, that the experience is changing fast. So the next cohort's experience will be very different from the current and then the cohort after that. The other is that there's a lot of unintended retirement. And this is where I think our paper adds value. We look very much at the labor market experience and interaction of older workers. And people often assume that they can do what they want to do. But in fact, they can't do what they want to do. They assume they can work when they want to work, but sometimes you get unemployed. And when you're unemployed and you're 55 or you're 60, you're at the back of the line. And so you expect to use labor income as an insurance mechanism, and turns out you can't. So let me go through what we found. So first we looked at consumption. So this is from the Consumer Expenditure Survey. This is real spending per capita, so deflated by the PCE consumption deflator, per capita by age of household head, starting when we could, in the mid-'80s, and going through 2012. And there's a couple of conclusions that we draw. I don't know if you can see, that bar is kind of getting in the way of the age of the household head, but the green line is 75 and older, and the dark blue line is 65 to 74, and pretty much it descends by age. So, you know, one of the clues, and then what the table does is it shows the cumulative increase in spending, and this is what we care about, right? Spending, smoothing consumption, and you know, we'll just take all the concept that the survey measures these concepts appropriately. The cumulative increase in living standards between 1984 and 2012, and then what's happened between 2007 and 2012. And what we see is, well, here's the good news. Everybody is a lot better off than they were in 1984. A lot. And so we've all gotten better off. And that's true for elderly, and that's true for young people. That's great. The elderly are doing really great. The current elderly are doing fantastically well. Their living standard has improved, and I show you the level of the living standard to show that it's not just the fact that they started at a much lower living standard. They started you know, at a reasonably similar living standard and now have a higher living standard. The 65 to 74 have the highest, well, the 55 to 64 actually have the highest current level. But in terms of gains, the elderly have done the best. In terms of how people have fared since the Great Recession, this is where it's quite interesting. Again, the elderly have done better. They saw a loss and then they've recovered it. And so they're on par with where they were in 2007. But not such good news for the younger cohorts. Their spending per capita is still below where it was in 2007. And I think one of the interesting groups in this chart is the red line there This is the 35 to 44-year-olds. Their consumption is still going down. Now, this may be that these people see the writing on the wall and are actually saving more and sacrificing some of their consumption to protect their future consumption. That's a possibility. But, you know, just, again, the takeaways from looking at the consumption per capita is that everybody's doing better, but that the older households, the current older households, have done quite a bit better than the younger households. Now, using the same consumer expenditure survey, we looked at where income is coming from. How are they financing that consumption? So the left-hand side shows you the share of income that is coming from work, and then the right-hand side shows you the share of income that is coming from all pensions, public and private. We can't break it down between, you know, Social Security and other sources of pension income. And here's where you can start to see the changing nature of retirement, right? So everybody, including the older people, are working more, and these are on different scales, keep in mind, so that's quite important. So the elderly are getting, the oldest group is getting, you know, about 20% of their income from work, as compared to about 10% in the 80s and 90s. So a little bit more working there. For the 65 to 74-year-olds, it's from 30 to 45%, so quite a bit more coming from work. But the pension is where the change is coming. The 75 and older have pretty steady income shares, and it's quite a bit. Most of their income is coming from pensions, public and private, whereas for that younger cohort, and of course they're younger, so you would expect it to be lower, but that's where the changes are coming from. So yes, the pension income replacement rates, if you will, are going down for the next generation. This is another thing that we looked at, which is the percent of households with a mortgage by age of head of household, and this is also something that's changing. So it used to be that a small fraction, and here I'm just looking at the people who are coming up on retirement. So the 55 to 64-year-olds, 65 to 74-year-olds, you know, have they paid off their mortgage? Is that part of their retirement plan? Are they insuring their consumption streams that way? Used to be a very prevalent thing, less prevalent now. So a lot more households still coming, you know, in older ages, having a mortgage obligation to pay off. So that's a source of risk for these older households, particularly when you see what we find in the labor market experience. So this chart just shows you the labor force participation rates by age. What we see is, you know, this is over a much longer time horizon. Before there was a trend towards earlier retirements, you know, to Olivia's point of the high water mark, you know, marked by ERISA, you know, then things started changing and people started retiring later and later, and that trend is ongoing. That trend has been a bit arrested for the 55 to 64-year-olds. So we were on this rising labor force participation trend, and then it plateaued. So one of the things we want to look at is that voluntary or is that involuntary? Okay, so first thing we do is we break it out by men and women. So the left-hand side shows you participation rates by men. Again, 55 to 64 and 65 and over. So for men, the 65 and over, yes, you are seeing an upward trend in labor force participation still. With the 55 to 64, it fell and then kind of stayed. It's plateaued, and it hasn't been on an upward trend. For women, it's quite different. So women didn't see as much of a decline because that generation had lower participation rates. And then it was on a steady upward trend for the 65 and over, still very much on an upward trend, of course, relatively low participation rates, but trending higher and higher. For the 55 to 64, that's where we saw the flattening out. Again, is that voluntary? Is that just a natural end of a shift in behavior? or is there something else going on here? Oh, goodness sakes. Okay, so the question is, can older people work when they want to? This is from the Retirement Confidence Survey. Since the recession, there has been a marked jump in the fraction of people saying that they retired earlier than they planned. So something's going on. They planned on retiring later and they retired earlier. Either everybody's doing a fantastic job of saving or something else is happening. Well, here's the unemployment rates by men and women across the age groups. They are improving, but they are very high, higher than they have ever been, certainly during the recession for a longer period of time. So there are a lot of unemployed older workers. So yes, some of this is unintentional. And so you planned on having more of a insurance to your consumption stream from work than you actually had. And again, very persistent. Okay, I'm going. Okay, and then the left-hand side, people 55 and over who've left the labor force. So the participation rate, they're not in the labor force participation rate, but they say they want a job. Again, that share of people has risen. You know, the numbers are small, about half a percentage point, but half a percentage point of the population 55 and older, you know, say they would come back into the labor force if the jobs were available. Then there's also underemployment. There's people working part-time who want full-time jobs. That's on the right-hand side. So I show the whole population 20 and over. It's a much bigger problem for younger workers, but it is still relatively elevated for older workers. So people aren't working. They may be working, but not as much as they want to be working. So a lot of underemployment for older workers. So the answer is no. Not everybody can find work when they want it. There's a lot of unemployment, a lot of discouraged workers, and a lot of underemployment amongst older workers. Okay, so conclusions, since I have a minute left. I'm out of time. Okay, quickly, conclusions. Everybody's seen their standard of living increase. That's great. There was a windfall generation, as Karen Pence at this forum a couple of years ago called them. The current retirees had the baby boomers. They are, you know, they experienced both real income gains and asset price appreciation, and life is pretty good. And life is going to be harder and full of risks, including labor market risk for older workers. And that's something that needs to be factored into people's plans. You might become unemployed. You cannot assume you're going to have a job when you want it. And that has to be part of the plans. What does that say? Well, to me, one of the things it says is get rid of that mortgage. I don't care how low the interest rate is. It's a dumb thing to have a mortgage if you're over 55. That's a perfect, easiest. You don't need to be financially sophisticated. People in finance like me don't usually go around saying, don't give us your money, use it to pay off your mortgage. But for most people, that'd probably be a really sensible thing. I'm not affiliated with anybody right now. I can say that, and I'm saying it, and that's it.